So how did life insurance originate? First of all, what is life insurance? Life insurance is a type of insurance that pays a sum of money when somebody dies. Well, how did life insurance originate and where did it even come from? It's interesting to note that life insurance is really one of the oldest types of financial products in existence, in history. Back in the old days, there was a principle that when a person's house had burned down in the village or the neighborhood at that time, the other villagers would help to rebuild that house for their families. Life insurance has stemmed from that principle. Years later, a concept that was known as the tontine annuity system had its origins in Paris by an Italian-born banker in the 17th century named Lorenzo Tonti. It was very similar to gambling, however, as it had used the law of averages and the principle of life expectancies in establishing annuities. Under the tontine system, a fund was created. Equal contributors from each member of an association of individuals, regardless of age or background, could contribute. The concept was simple. A sum of money was invested, and at the end of each year, the interest was then divided among the survivors. Well, what would happen to the last remaining survivor? He was the fortunate one that would receive both the year's interest and the entire amount of the principal that was contributed. This created some issues, however. The amount of money fluctuated more and more as people wanted to be insured. This would cause volatile fluctuations as those that were involved in the system increased. This effect needed to be minimized. So it was important to introduce the law of large numbers. Basically, when it is applied to life insurance, the more people that a risk is spread out over, the more money in the form of premiums or insurance expense will be coming in. This means that when a person dies, it will not be as big of a burden on the rest of the people who were insured. Remember, the function of insurance in general is to safeguard against misfortunes by having the losses of the unfortunate few be outweighed by the contributions of many that may be exposed to the same environmental hazards or dangers. So that brings us to modern day life insurance. Life insurance will assist the beneficiary when there is an economic loss caused by death of the insured. This can extend far beyond just the funeral, hospice care, or final medical expenses. It is realized that purchasing life insurance is a very uncomfortable task for many, many individuals. I often talk to people who do not want to refer to it as a death benefit, but just as a living benefit. This does not need to be as morbid of a subject, as we can focus on the living benefits of a life insurance policy. Namely, focusing on the cash value component that allows you to practice what's known as infinite banking. This results in uninterrupted compounding growth and interest and will allow you to borrow out from the cash value component for whatever purposes you may need. Click the links below to find out how you can use the living benefits of a life insurance policy using the principles found in the infinite banking concept. Also, if you'd like to know how to build your own infinite wealth engine using a cash value life insurance, we'd love to help you out with that as well. Click on the link below for a free PDF to get you started. Brandon here from Infinite Wealth Engine saying, stay healthy and stay wealthy.